So tonight you're tracking NCB, which has been on the rebound lately. What is causing that, and is it sustainable?
All right. So let's take them piece by piece. So let's start off. Let's take a look first at the company's performance, right? So, all right. So first off, the numbers, the earnings for the company has been improving. So of course, they went through a bit of a period. So when you look on the performance for going back from financial year 2014 for them, they've steadily increased up to 2022. And then of course they kind of fell off a bit. So you see that even into FY 2024, right? But if you look on the trailing numbers, you can see that recovery coming in. So this is more on the operating profit, right? It's a bit more volatile. So this is the total operating income. So of course, this is taking the investment side of the business and the insurance side of the business, right? So you can see that trend there largely higher, but towards the tail end, but in recovery, right? Now, when you look on the profitability now of the company, so this is specifically profits attributable to shareholders, right? That's been a bit more volatile. Of course, it's a big decline there in 2023 when they did the whole restructuring, and then you're seeing the recovery there. And at the tail end there, you're seeing that it's around $20 billion in terms of the trailing profitability of the firm. And in fact, when you look on the most recent quarter, so that's the June quarter, you're seeing that the profitability was up around 11%. And when you look over the 9 months period, it was up around 60%, right? So you're seeing some strong rebounds there on the tail end. In fact, I think the 9-month numbers actually exceed all the FY 2024 numbers in terms of the profitability of the firm. So it is improving on that metric also. Now, when you look at the equity, so you can see the equity of the firm been trending higher over the period. It was a bit of a lumpy period, again, around 2022, 2023. Part of that have to do with IFRS 17. And of course, valuation of some of the assets on their books, but largely trending higher again, right? So good there. Now, here's how we start to touch into the recent performance. So the recent performance is there in the tail end of the graph. The next slide, I guess, will clarify it a bit more. So this is the historical price to book ratio of the company, right? So you're going back all the way to 2014, right? What you realize, interestingly, is that the price to book ratio of the company now, it's around the lows that you had around 2014, right? So of course you can see all the high there when the market was very enthusiastic. It was trading close to 4 times book. Right now it's trading a little north of half book, so it's like 0.61% times book. So basically a fraction of book value. But it's in recovery, but you can see it there at the tail end. So if you go into this slide here now, you can see the actual price movement of the stock. Right, again, coming from the highs in the 2020 in late 2019 going into 2020, and of course it's at these lows, and towards the tail end there you can see that little bump up. So here's what we're looking at here now. So I had mentioned it earlier now about the recovery. So this is the part that we're looking at here. So year to date still down, still negative year to date. However, it's way better than it was at the lows of the year. So the lows of the year was down over 40%. Wasn't doing so hot. Earnings came out. Okay, you realize that sharp move there. So earnings came out August 8th, somewhere around there. When that came out, the stock price shot up. The numbers were fairly decent. It's the same numbers I mentioned, the June numbers, were fairly decent. But I think there was a lot of fear in the market that it wasn't gonna be so hot. And I think that fear was subsided when those numbers came out, right? Because I think overall the sentiment on the stock has become overly negative. Because there's a lot of talk in the media what's happening with the firm. So what you even saw in July in particular, in July the company had the worst month that it had. The shares had the worst month that it had going back to 2013. So it's the 26% that month was the worst month. Subsequently, though, which is we're seeing a rebound there in August, it had the best month that it's ever had going back to 2013, right? And that recovered most of those losses and then some, right? And then of course September, it's doing decent in September, up about 9%, right? So there is some recovery there. So to your point, yes, the rebound is there. Now the question is now, what can we expect a little bit going ahead in terms of what's happened, right? So I'm going to answer that now by just touching on some other information points. So first off, the dividend. So what you're looking at here now is the dividend yield for the firm. So if you go back a bit for like 2014 financial year. So basically how this is looked at is the dividend yield of the firm when you look over a year period in terms of a calendar year. How much dividends declared for a year and what's the average stock price in that year, right? And then now you take a look on that and you can see historically it's been pretty high back in 2014, 2015. Of course, we know that dividends paused a bit, slowed down, so then you see that low point there and it's kind of picking up now. So remember, the dividend is a function of two things. It's a function of the amount paid and it's a function of the stock price. So of course, you can be paying more, but the stock price up a lot. So then you don't really get a high dividend yield versus, a lower stock price with a higher payout amount in terms of dividend payments. So when you look at it from this point of view, well, this is a bit messy, so I forgot to clean that up. It's a bit messy, but hopefully you can make it out here. So when you look at the dividend amount, right, the amount peaked around $3.60 a share. And you can see that steady increase for them. And then, of course, you had that lull period, and you can see that pickup again occurring in terms of the dividend payments, right? So it is a steady dividend payout. Again, for a period it wasn't, but now it's back, right? And yeah, so all right, so this is the final chart here. So just to wrap it up. So when you look on the overall performance at the start now, so again, you have the capital gains in terms of just the stock price movement, and you have capital gains along with reinvesting, right? You can see that there's been, if you just look at capital gains over that extended period going back from the end of 2015 to present, you'd see that it's up around 143%. But if you include the dividends that is paid over the period, which I alluded to before, it would have been somewhere around 209%. Now, so to answer that question, so yes, you've seen the recovery. You've seen the recovery in the stock price, and you've seen the recovery also with the performance of the company. However, there is still a lot of talks in the market in terms of some negative sentiments around it. So that of course would weigh down on the stock a bit. However, as long as the company continues to perform, I think in the medium to long term it should be fine in terms of they continue to grow profitability, control costs, pay higher dividends. Then the sentiment can shift and move more to the positive. I think clearly, as of course that's in the rear view mirror now, we can say that the July negativity was kind of overdone in terms of the sell-off that occurred there. It was drastic, and then of course, followed with a drastic improvement in the stock price. So that is behind us, but we can use that as a guide to see that from time to time in the market, investors can get a bit overly negative,
and overly positive.
and overly positive. Yeah,
both ways.
Both ways, because we saw where, as I showed before in the earlier chart, where the price to book ratio at one point was about 4 times, which for a financial firm is you're being very optimistic for a financial firm, because of the nature of the business. A price to book around 4x is pretty aggressive. So of course that would probably point to over enthusiasm. But right now on the flip side, you can see trading at 0.61 times book is you could argue is a bit pessimistic, right? So it kind of swings both ways. So that's a fair point.
It's a lot pessimistic. It's almost half of the value.
Yeah.
So Garfield says you've not indicated what is driving the recovery.
Okay, all right. So the recent recovery, I pointed to that, is the earnings. So there's a clear, when you look on the decline in the stock price, and then when it took off, is that there's almost a clear indication of it taking off right when the earnings came out, right? Then the stock just went straight up, right? What drove the massive sell-off? I can't answer for sure. I don't want to speculate. So I have my views as to what drive it, but that would be more speculation. So I'm going to leave that out. But in terms of the recovery, though, that was clear as day in terms of the when the recovery took out and when the earnings came out. And of course, you had rumblings in the market at the time in terms of confidence, but then those earnings, kind of shored it up that, the company's fine, they're doing well. And I think investors responded to that well. So I think that was the clear driver of the recent recovery. As to what can keep driving it, I think that would be it. The company would have to keep performing, generating that profitability, paying those dividends. And I think in time, that would be the driver of them going forward. If they're not able to do that, then of course it could, could be in for a rough ride a little bit, but that's the driver that's going to be needed to move the company forward. And they are set up positively for it. You see, because it's trading at 0.6, because of the current book value it's trading at, and the price to earnings ratio, which I think is around like 6 times or something like that, there isn't an egregious amount of optimism in the stock. So that means basically they have a high hurdle to jump. So it's not like the company has to be growing profitability by 50-60% in order to meet expectations. It just needs to do a steady steady like 10, 15 steady growth back to the historical levels of profitability, and of course growing dividends along with that, and that would be enough because it's already priced so cheaply. So it's not expecting a lot in the current valuation from the company.
We have quite a few comments on this topic. Phil
Okay.
says, overly positive on the JSC. When? Bring back those olden days.
Yeah, that's yes, but yeah, those days.
Yeah,
Yes, those days are good.
2019 was the peak of it. 4
Mhm.
times book value. Come on.
Yeah, that was something else. But yeah. Mhm.
A few more. So talking
Yeah.
about the reason for the rise in the stock price.
Yeah.
Where's the comment? Kirk says the catalyst was the major shareholder.
Okay. All right. I'm not really 100% sure what he's getting at there, but I'm
Let's
not
not go
sure.
too deep into that.
Yeah.
Learn Grow, because you
Mhm.
know they watch this show, right?
Yeah, man.
Where is it? Learn Grow, Learn Grow. Had a comment I wanted to read. All right. So you mean the one-off earnings boost from the sale of assets? So is it that earnings are legitimately and genuinely and sustainably
Yeah, all right.
increasing, or was it because of this one-off sale of
Yeah,
assets?
so that's a good point. So that one-off seeding assets did help boost the numbers of the firm for the quarter. For the 9 months period, it did help boost the financials for the firm. I think it occurred in the Q2 numbers, if I'm not mistaken, in terms of to help boost the numbers overall. That being said, though, what the Q3 numbers have shown though is the stability of the firm. So that that's a good point, because I think that was something that occurred at the Guardian level, and of course would filter up to the group level in terms of that one-off gain. So that's a fair point. However, the thing is, when you look on, I'm not looking at any one metric. So the profitability is one thing, but when you're looking at the recovery, for example, on the balance sheet, and you're looking at the different line items that are driving it in terms of the income and the interest, the income from the investment side of the business, and you're looking at the overall that market dynamics. So for instance, you're seeing the U.S. lowering policy rate. Oh, that was mentioned earlier in the show. U.S. reducing policy rate, and of course the implications that can have for the BOJ here, which in turn would impact the financial industry in terms of lowering rates and the implications of that for their borrowing cost and business, right? So the overall environment. But yes, I do take the point that that's a fair point. That there's a one-off gain in that number that aided the gains in the quarter in the 9-month period. Sorry.
So a
That's a
follow-up
point.
to that one from Cabby, recovery in net operating income. Not sure what the drivers are or whether they're sustainable or just the result of a one-off catalyst, which we just discussed. How do they compare to the industry?
Yeah, man. So all right. So in terms of so on the investment side, so the investment side of the firm, the overall industry, you are seeing recovery in the overall industry. Scotia, of course, is kind of anomaly in terms of the setup of their business. So they've been doing well steadily through the period. But if you're looking like broader across the industry, so whether it be your Barritos, your Sagicors, you're looking broader across the industry, you are seeing a broad base recovery. Sagicor, I think, had some brilliant numbers coming out in their in their June numbers. They had some brilliant numbers coming out also. So you are seeing a broader recovery. I think Barrito also, if I'm not mistaken, did also good. They had some good numbers also. So I think overall, so NCB though, when you look at it across the industry, yeah, they're doing across the industry as well, and NCB is also doing well. But a key point to note though, even though these companies operate in the same industry, most of the companies, most of these, how I would term them is the financial conglomerates, kind of separate from like the more niche players in the space, like for example your Mayberries, right? The financial conglomerates like at NCB, each one of them they're very different. So for example, Scotia, for argument's sake, Scotia Jamaica only operates in Jamaica, while of course NCB of course would be huge in Trinidad, especially through Guardian and their other operations, and they're huge in Jamaica. So what happens is that when you look at the underlying dynamics that impact these companies, it's completely different. So even though they're similar in a sense, large conglomerates, the moving parts are wildly different. So because of that, what can actually happen, which we've seen actually in recent times, you can have a situation where a Scotia Group, for example, is performing very well, and then you have an NCB with a little bit more volatility in the numbers. So even though they're in the same industry, which is kind of unusual, but it's because of the nature. Each one of these building companies are extremely different when you look on even their geographic makeup.
Yeah. So Roswell says, yeah, the sale of assets in the group, investors need to understand financial statements. And we had somebody else commenting, Grandeur, commenting that PE is currently 5.6.
Yeah, so it's fairly low. Yeah, so it's one of the it's pretty low. But again, as pointed out earlier, that number would be a bit generous because of course the one-off gain would kind of boost it. But even if you take that out, it would still be probably around the 10, 11 ballpark, which is still pretty low. But that's why generally when I'm looking at financial firms, I tend to more focus on the book value because you can have a lot of volatility in the earnings from time to time, but the book value kind of gives you a more steady picture of what is happening with the firm. So that's why I tend to look more at the price, the book, and the book value of these firms. And then for financial firms, it's a much more pertinent measure of the value because the assets are readily priced. So it's not like a manufacturing firm that have a lot of PP&E, which is kind of like specialized equipment that's not really marketable. Because of the nature of financial firms in terms of the assets that are usually on their balance sheets are pretty liquid, using a book value in order to measure them is usually a pretty good metric of the long-term value versus more than other industries. So that's the reason I tend to look at it, because it tends to smooth out more these one-off gain impacts, and you can kind of see the long-term value of the company.
Okay. Thanks so much for that insight and analysis as usual, Leo. Much appreciated.
You're welcome.